Hello, everyone. Welcome back to the Weekend Charts special edition today called The State of the Markets. We haven't done this in a few months. I thought it would be a good time for an update. So here we go. The State of the Markets, February 2025. What are we going to be discussing today? A lot, pretty much everything. Stocks, bonds, the Fed, real estate, housing, commodities, currencies, crypto, intermarket analysis, and we'll end with the U.S. economy. So let's start out with the stock market and talk about one of the longest uptrends that we've seen in history, second longest, in fact. This would be looking at the NASDAQ 100 index. We've now gone over 2 years without this critical index, NASDAQ 100, many of the biggest stocks within this index. 2 years plus without closing below its 200-day moving average. So very smooth uptrend here. 481 consecutive trading days. Only the period from 2016 to 2018 was longer than what we've seen. And actually, this index is up 82% during this period of time. So very unusual to see this smooth of a ride that we've seen in the NASDAQ 100 over the last 2 years. And if we look at the S&P 500 hitting yet another all-time high this year, following the 57 that we saw in 2024, which was the fifth most of any year in history. And if we look at the S&P 500 here over the past year, up over 22%, pretty good return, more than double the historical average, which is about 10% per year. And what's driving these big returns? Well, two things. Number one would be the improving underlying fundamentals. So if we look at things like earnings here, this is operating earnings. Looking back the last 12 months, you can see here in the fourth quarter, we have about 70% of companies that have reported, and we're hitting record highs again. We're on pace to hit record highs, up 9.5% year over year. So very strong quarter again for S&P 500 earnings. But it's not just a story about earnings. It's also been a story about sentiment and multiple expansion. And I've been showing you this chart, but I'll show it again. S&P 500 price to peak earnings ratio remains elevated here, 25.3 versus the historical median of around 17.2. So definitely elevated, not at the highest levels that we saw in the late 1990s and early 2000s, but definitely well above the historical median here looking at valuation. So we have that fundamental improvement in terms of earnings are growing pretty rapidly here, almost 10% over the last year. But you also have the factor that investors are a lot more optimistic and paying a premium in terms of the price they're paying for a given level of earnings. And so another way to look at valuations here is to look at the CAPE ratio, so smoothing earnings over a 10-year period. And what we see here is this is the highest valuation for U.S. equities at the start of any presidency, looking at that CAPE ratio going back the last 100 years. So if we're looking at Trump's second term here, we started out with a CAPE ratio of 37.8. That was higher than any other start to a presidency. And historically, when you get this extreme in terms of valuations, we're in about the 97th percentile historically looking at this CAPE ratio. What you tend to see is below average future returns. So we're all the way on the left side of this chart. Highest decile of valuation tend to be followed by below average future returns. But really, valuations tell you nothing about the short term, what's going to happen the next month, the next year. Valuations that are high can always get higher in the short term. But really, what this means for longer term is investors should temper their expectations. Don't expect the next 10 years to be as good as the last 10. And talking about high expectations here, it's really reflected in the earnings estimates for 2025. What I'm showing you here are the current estimates, and what investors are expecting is 15% earnings growth in 2025. Now, this has come down. It was over 20% a few months ago. It's come down, but still pretty high. Historically, the average in terms of S&P 500 earnings growth is about 6% per year. So some might argue that those high valuations are justified because we're going to indeed get this high earnings growth in 2025 and 2026, and we're going to get a few years of rapid earnings growth, and the market will grow into those valuations. If that's true, then perhaps that's the case. The question arises, well, what if earnings are actually much lower than what investors are expecting? Then you have high valuations, and you have earnings growth coming in as a disappointment. That'll be a question that we ask throughout the year, I think. But right now, as the setup is, the market is expecting these companies to deliver. They're expecting the AI revolution to produce enormous earnings growth in the years to come. So let's take a look at some ratios. Start out with the US versus the world. US has been dominating in terms of performance, dominating the global market landscape, outperforming international equities for over 16 years. This is by far the longest period of outperformance that we've ever seen for the US versus international stocks. But if you could see this right part of the chart here, year to date, it's actually reversed a little bit. US stocks were only on February 10th here as we're talking, but US stocks up 3.2%, and MSCI World X USA ETF is up 5.2%. So a little bit of outperformance so far in 2025. We'll see if this actually continues again. It hasn't been that long. You're talking about 16 years of outperformance of the US versus the world, but we've rarely seen the US lag for any period of time. So if this were to continue, it would definitely be notable. Let's talk about the second major relationship that has been pretty stretched in recent years. This is US large caps versus small caps. And you can see the chart here has been going up and to the right because large caps have been outperforming. And last year in 2024, it hit its highest levels since October 1999. So you can see here, pretty stretched. In the last 2 years of the S&P versus Russell 2000, we saw back-to-back years of huge large cap outperformance. We actually hadn't seen that big of an outperformance in a 2-year period since 1997, 1998. The third ratio that has been at an extreme and actually in December hit its highest levels since March 2000 is the ratio of growth to value. Looking at the Russell 1000 here, and that hit its highest levels since the peak of the dot-com bubble. But you could see here a little bit of moderation coming so far this year with value stocks outperforming by a little bit. But the last 2 years really unprecedented. We've never seen growth outperform value in a 2-year period by this much. In 2023, 31% outperformance by growth. In 2024, 19% outperformance. That was even more than the 2-year period in 1998, 1999. And you could see what happened after that, huge outperformance from value stocks. So a lot of investors are questioning, saying, are we nearing a point where we're going to see a reversal in this relationship? So within the market here, if we're looking at sectors, the big story in the last decade plus has been obviously the outperformance in the technology sector. Last July hit its record high versus the S&P 500, actually surpassing the peak in March 2000. And since then, interesting thing is, very quietly, we've seen underperformance from U.S. technology shares. Not a lot of people talking about it, but if we look at the peak in this ratio, occurred July 10th of 2024. Since then, there's only one sector that's lower in the S&P 500, and that's the XLK technology ETF. All the other sectors positive. So while the S&P 500 has continued to hit many more all-time highs, it's done so without the help of the technology sectors. You can see the huge spread between the tech sector being down and at financials leading the way since last July, up 23.6%. And of course, within the tech sector, what has been far and away the best industry group over the last decade, that would be semiconductors, of course, led by NVIDIA, now one of the biggest companies in the world. But interesting to note here, in addition to the technology sector underperforming, you see semiconductors underperforming since last June. And actually over the past year, semiconductors are underperforming the broad S&P 500. I think that would be a stat that would surprise a lot of people. So something to continue to watch here. All of these relationships, U.S. versus international, growth versus value, large versus small, and this very important relationship of the semiconductor industry. Is this marking some type of turning point for leadership? Okay, with that said, if you're thinking about 2025, how to allocate your portfolio, we're here to help at Creative Planning. Go to creativeplanning.com creativeplanningcom/Charlie. Schedule a call or a meeting with an advisor to get a free wealth path analysis where we're going to help you with your portfolio, your financial plan, your tax situation. If no tax season is coming up very quickly here, we have over 300 CPAs to help you prepare your taxes and also work with wealth managers to try to maximize your potential return. So reach out today, creativeplanning.com/Charlie. We're in all 50 states at Creative Planning, so we likely have a location right near you. Over $345 billion in assets under management and advisement, and we're here to help. Go to creativeplanning.com/Charlie. Okay, let's move on, talk about the Fed and talk about bonds. What has been happening in the bond market? Longest drawdown ever. This continues here, 54 months now and counting. And there's nothing really historically even close to this. You can see the number 2 bear market on the list here, 16-month drawdown. So we're far and away and ahead of that period of time. And we're talking about here still 8% below the high from 2020 when interest rates hit historic lows. So it's going to take some time to recover from this, even if we see interest rates come down a little bit. If they're going to have to come down a lot to get a full recovery here. Otherwise, you're talking about a few years of coupon payments. So what's been going on within the bond market? We've seen massive outperformance from credit sensitive areas over the past year. If we're looking at EM high yield or US high yield leverage loans, that has been really the leadership over the past year. And what has been lagging has been duration sensitive issues. If we're looking at long-term treasury bonds like TLT and zeros here, those have been hurt because interest rates have drifted higher on the long end of the curve. Now, here's the good news. So we talked about the bad news. It's been a painful 4+ years for bond investors. The good news is we're in a much different place today in terms of the bond market. You can see here the aggregate bond ETF has a yield of around 4.6%. If we're looking at the 10-year, we're at a similar level, around 4.5%. And historically, there's been a very high correlation between that starting bond year yield and 7-year future returns. So the expectation today should be much, much higher than a few years ago because we have a much higher starting yield. So we're looking likely at a range of between 4 and 5% for the bond market looking ahead the next 7 years. What happens in the next 7 months? Well, that's going to be more dictated by the direction of interest rates. Obviously, if interest rates go up, they go above 10%. That 5%, there's going to be pain in the bond market. If interest rates go down sharply, they get back below 4%. There's going to be obviously better short-term returns. But if interest rates just stay where they are and they don't go anywhere, you're going to see at least 4 to 5% returns because that's what the actual coupon is. And if we're looking at why have credit sensitive areas done so well, well, this is the main reason. It's because credit spreads have been tightening. So this is the yield above the risk-free treasury asset that investors are demanding. And early this year, it actually hit, if we're looking at high yield bonds in the US, actually hit its tightest level since June 2007. Rarely has this been lower than where it is today. So a lot of optimism in the credit markets, very few defaults being priced in today. So similar to high valuations in the equity markets, you could say this is indicative of high valuations in the credit markets where there's a lot of optimism and very little pessimism, very little fear in the credit markets. When there's fear, you can see what happens. These spreads blow out. Investors demand a high premium for buying these bonds. They need a high spread above the rate of treasuries today. Very, very tight spread. If we talk about the yield curve here, you can see we're back in positive territory. We went through the longest period in history of an inverted yield curve where the 3-month treasury bill yield was above the 10-year treasury yield. Now we're back in positive territory. The 10-year has a higher yield, 4.51%, higher yield than the 3-month, 4.35%. Why has the yield curve turned positive again? Well, the main reason is the Fed started cutting interest rates last year, bringing short-term rates lower. And the second reason is 10-year yield has been drifting higher here as inflation expectations have been moving higher. So that combination, you're seeing the yield curve has been steepening over the past year and now in positive territory once again. So talking about the Fed, what are the expectations? So they had their meeting in January. As expected, the Fed did nothing. They held rates at between a range of 4.25 and 4.5%. And right now, what the market is actually expecting is really pricing in only one and maybe two rate cuts in all of 2025. So big shift from where we were a few months ago, with the market essentially saying the Fed, maybe they cut one more time and maybe that happens in June or July of this year. But looking at the recent inflation data, looking at the employment data, as we'll talk about in a little bit, the Fed doesn't seem to be in any rush anymore to continue cutting interest rates. And if we look at that March meeting, these are the probabilities right now, 95% probability right now that the Fed will keep interest rates at 4.25 to 4.5%. So if we're a week out of this meeting and these are the odds, you can be pretty sure the Fed is going to do nothing and keep rates where they are. And if we look at the spread between the Fed funds rate and core PCE, this is the Fed's preferred measure of inflation. The Fed is viewing this as sufficiently restrictive policy because of the spread between the two. And what they really want to see is this inflation rate start to trend lower again before they even think about cutting rates and moving them down. So the Fed's target is 2%. The core PCE inflation rate, you can see here, has been drifting up, moving away from 2%. It never actually got to 2%. And so the Fed, for now, is on pause. And what they need to see is lower rates of inflation or some real weakness in the economy. And right now, they're not seeing evidence of either, and that's why they're on hold. Okay, so let's talk about the real estate and housing market. We'll start out here with the real estate ETF, the VNQ versus S&P 500. So we talked about S&P hit 57 all-time highs last year, hit another one this year. So far, the real estate market, if we're looking at the broad VNQ ETF here, still off of its highs from a few years ago, so still in a drawdown. And this is looking at the ratio of the real estate ETF to the S&P 500. You can see here just a downtrend in terms of performance, with real estate underperforming the U.S. equity market. Now, if we're talking about housing here, rising prices and falling affordability has been the story. It's been a kind of a Groundhog's Day story over the past 2 years. It just continues to get worse because prices continue to outpace the growth in people's incomes. And you could see Case-Shiller National Index still hitting record highs and housing affordability index just languishing near record lows. And this is the chart that's caused a lot of problems in the housing market. It's the fact that home prices nationally up over 50% in the last 5 years, while U.S. average hourly earnings, so your wages, up about 25% on average. So that widening spread has caused the housing market to simply be unaffordable for most people. This is another way of looking at it. And what the Atlanta Fed is doing here is they're calculating, well, what is the income you would need to afford the median house that's for sale, and what is the actual median income in the U.S. And you can see here, there's a 49% gap between the two. So the actual income is much, much lower than what you would need to afford based on current prices, which means that one of two things needs to change. Either prices come down or incomes go up or mortgage rates come down. So you need to have these the affordability equation change in some way to close this gap. So the bad news has been that the supply has been so low that prices really have continued to outpace wages, but we're starting to see a little bit of light at the end of the tunnel there in terms of increasing housing supply. It's not enough yet to cause home prices, let's say, to retreat nationally, but we're actually seeing a pretty rapid deceleration in terms of the rate of increase in home prices, and I think this is the major factor driving that. You're actually seeing much more supply than we saw a few years ago. This is looking at 2025 so far, 12.5% more homes for sale in the U.S. than a year ago. You can see higher than 2024, 2023, 2022. So good news. Hopefully this trend continues. Hopefully the housing market becomes more affordable at some point this year. If we're looking at the rental market, very different story than the housing market to purchase. It's actually becoming more and more affordable to rent an apartment in the US because rents have actually been coming down and are actually lower than they were a few years ago, while wages in the US have continued to go up. So what I'm showing you here is the US asking rents adjusted for higher wages, and we're actually at the lowest levels we've seen in about 4 years in the US. So just great improvement in terms of affordability in the rental market. And what's driving that is actually the opposite of what's going on in the housing market to purchase is we're seeing a lot of supply, so a lot of vacancies because there was a huge amount of building and construction in terms of multifamily housing. So now we have the highest vacancy rates in terms of apartments that we've seen going back to at least 2019. 6.9% is the national vacancy rate. So this means we should continue to see more good news in the next few months in terms of rents becoming more and more affordable. Okay, let's talk about commodities here. And first, I want to give a long-term backdrop here. If you're talking about commodities as a long-term investment, at least since the first commodities ETF came out back in 2006, they have not been a very good long-term investment. You can see that barely any gains since then on a total return basis. But let's talk about commodities over the past year. You could see big difference in terms of gains and losses. You have coffee here trading at record highs, up 120% over the past year. Natural gas all of a sudden spiking higher, 83%. You of course have gold having a very strong last year, 44% higher. Silver around the same, 44% higher. And if we look at overall U.S. inflation here, we're talking about 2.9% over the past year. And then we have the commodities that have actually fallen, wheat, crude oil, gasoline, heating oil, sugar, and cotton. So overall, some of these commodities are going up, some are going down. The most important of these, of course, are going to be things that you use to travel. So transportation costs, that would be driven by gasoline, things like heating your home, obviously natural gas there as well. And these other commodities, some of them are more discretionary than others. So overall, I would say a mixed picture in terms of the commodities backdrop. We're not seeing a broad-based advance, but definitely we're seeing some areas start to perk up here in terms of the upside. We're looking at things like corn, which has been down year over year for a number of months in a row. Now, all of a sudden, we're talking about higher prices. So it's definitely something to watch here. But if we look at gasoline, this has been a tailwind for U.S. inflation because we've actually seen gasoline prices moderate since they peaked a few years ago on a year-over-year basis, and they're still down 2% year over year, but we're not seeing a huge decline. So that's not going to be a huge factor helping overall U.S. inflation. And of course, if we see prices start to move in the other direction, we're going to be talking about pretty soon year-over-year increases. But right now, not in a bad place whatsoever looking at U.S. gas prices. If we look at gold here, it's been a story in the past 2 years of huge outperformance, gold outperforming the broad commodity index. Gold had been underperforming for the period prior to that, had a very difficult 2022 when we saw interest rates go up, real interest rates. That hit gold and hit a number of asset classes. We actually saw crude oil spike higher that year. So we saw outperformance in the broad commodity index. But over the past 2 years, we've seen gold really take a leadership role. Now, if we look at the last 10 years, you got the S&P 500, 249% gain, gold 126%, and the broad commodities ETF here up 44%. So you can see gold definitely starting to trend higher, but still over the last 10 years, nowhere near what the U.S. equity market is, but definitely outperforming the broad commodities index. Okay, so let's talk about currencies here. What's been the currency story over the past decade? It's been the U.S. dollar trending higher versus almost everything else. You can see here, this is dollar index ETF hitting new highs again recently. And the two biggest factors in terms of the dollar are the euro and the yen. This is the chart for the euro. You can see the last 10 years, euro lower versus the dollar. And if we look at the yen, substantially lower, especially over the past few years here versus the US dollar. If we look at emerging markets, a little bit of a different story, starting to see a little bit of an uptrend here, which is interesting to see, something to watch definitely, because we've seen obviously emerging market equities underperform for many years in a row, and you tend to see some correlation between emerging market currencies and their equity performance. So this will be interesting to watch if we could see emerging market currencies start to trend higher. But getting back to the euro and the yen, why have they been weaker than the US dollar? A number of different factors driving them, but I think the two biggest are the differential, number one, in interest rates. If we look at central bank policies, you have Bank of Japan still extremely easy here, even though they're up to 50 basis points in terms of their central bank rate, so no longer negative, highest rate there since I think 2008, but you still have a negative real rate there, negative 3%. So still very easy policy given that their inflation rate is higher than it is in the US. And if you talk about the Eurozone, barely positive now in terms of their real central bank rate after they've done a number of interest rate cuts. And the US here, you can see the spread 1.5% higher than both of them. So the real central bank rate, real short-term rate, still much higher in the US than in the Eurozone and Japan. So that's one big factor, the interest rate differential. Second factor would be growth rates. Just look at the US's third quarter GDP, 2.7% increase year over year. And if we compare that with many of the European countries, 1.3% for France, 1% for the UK, Italy 0.4%, Germany actually down year over year in the fourth quarter. And looking at Japan here, 0.3% increase year over year. So higher growth rates and higher interest rates and higher real interest rates are the driving factors contributing to a stronger dollar. Let's talk about crypto here. This is a chart of Bitcoin and Ethereum, the two of them together. About 70% of the crypto markets, 60% is in Bitcoin, 10% in Ethereum. You can see Bitcoin holding up in recent weeks much better than Ethereum, which has had a pretty decent sell-off here. But the story over the past 2 years has been Bitcoin taking share from the rest of the crypto market. In November 2022, Bitcoin was 39% of all crypto assets. Now you're talking about Bitcoin being over 60% of all crypto assets. So you could see this chart increasing. Bitcoin's dominance has been increasing over the past 2 years. In January, Bitcoin hit 109,000 for the first time. It's since retreated. It's trading now at about 95 or 96,000. But you could see just an incredible run last year, with a lot of that coming after the election. Went from 74,000 all the way up to 108,000. But Bitcoin is a story of corrections. It's not just a straight line higher. There hasn't been a major correction in some time, and anyone who understands Bitcoin know that there's another big correction coming at some point. What we've seen in the past 6 months is a huge advance without any major decline, but almost every year you see a decline, 20, 30, 40%. So likely one is coming. We saw one from last March to August, 33%. And of course, we've seen many declines that have been much bigger in 2021 to 2022. November, 78% decline. We saw an 84% decline from December 2017 to 2018. So Bitcoin, high volatility, high risk. It's been high reward historically. It'll be interesting to see what happens this year in terms of Bitcoin. You're talking about 2 straight years of enormous gains, 156% in 2023, 121% in 2024 so far this year, up just a little bit for Bitcoin. What I've been talking about in the last month or two has been really the increase in speculative activity in terms of the crypto market, and asking the question, is this a signal for the broader market that sentiment has gotten too frothy here. And it's starting to play out in terms of these meme coins, where we're seeing Dogecoin come down significantly from where it was a few months ago. To me, the Dogecoin advance during after the election made absolutely no sense, because if the Department of Government Efficiency is going to be effective in what their goal was, and that's reduce spending, reduce waste, reduce fraud, then the idea that you need to have these alternative meme coins like Doge to protect yourself against the waste from the government and the dollar depreciation really goes way down. So that never made any sense to me why this thing was rallying. And you can see here definitely starting to pull back and pull back in a massive way. Then of course you have Fartcoin. Its market value was over 2.4 billion. Now it's down to around a half a billion. Still incredibly high, but obviously a huge decline, giving back most of the gains from the past few months. And then you have the official Trump meme coin mania that was announced before the inauguration, and it spiked higher, and it's since lost more than 3/4 of its value. So the question is this going to spill over into things like Bitcoin and Ethereum? It already has, in terms of they've pulled back, but we haven't seen yet that major correction. And at some point, obviously, it's coming, because this frothy sentiment has to be flushed out and a new cycle will start. But when that happens, or how big or how much of a decline it's going to be, is anyone's guess. Okay, let's talk about intermarket ratios here. First, I want to start with stocks versus bonds. You can see last 10 years has been a story dominating by the stock market over the bond market. No surprise there. We just talked about the biggest and longest drawdown in bond market history, which is still ongoing. You can see here huge outperformance in stocks in 2024. And if we're looking at the relationship between stocks and bonds, what's been interesting over the past 3 years is we've never seen the two move together at a higher correlation than they have in the last 3 years. So 0.73 correlation between the US stock market and the US bond market over the last 3 years. Highest ever simply means when stocks have been up, bonds have tended to be up, but when stocks have been down, bonds have tended to be down more frequently in the last 3 years than ever before. But correlations don't equal returns, and you can see that in the chart right here. Looking at the last 3 years, you can see S&P 500 is up over 40%, while the US bond market is down 2%. So when stocks have been up, yes, maybe bonds were up as well, but stocks were up way more during that period of time. And overall, the rise in interest rates that we've seen over the past 4+ years has really hurt the bond market. And you can see overall the stock market, yes, initially it took some pain there in 2022, but then it's definitely recovered and kind of shrugging off these higher interest rates. So very interesting to see. I doubt that we're going to see the correlation this high in the next few years. So be very careful in assuming that past correlations mean future correlations. I think you're going to see a more normal relationship going forward. And as soon as the inflation fear gets alleviated, where the biggest fear in the market is not inflation, then you're going to see really this correlation drop and go way down. So let's talk about stocks versus commodities. You can see here hit another record high, recovering from that big decline that we saw in 2021 and 2022 in this ratio, especially in 2022 when we saw crude oil spiking higher and a lot of other broad commodities. Since then, it's been all about the stock market outperforming. Stocks versus gold, you can see here sideways action over the past few years. Sometimes stocks have been leading, sometimes gold has been leading. Overall, in the last 10 years, stocks obviously outperforming gold, but much more sideways action over the past few years. And if we're talking about Bitcoin versus the S&P 500, you can see this is just dominated by obviously Bitcoin, because it's so much more volatile than the S&P 500. So when Bitcoin's doing well, it's doing very well, and this line is going up and to the right. When it's not doing well, it's having a bear market like in 2022, this is going down. So the story of Bitcoin has really been, in recent years, becoming more of an amplified version of the equity market. And I talked about this recently, looking at the correlation between Bitcoin and the S&P 500, you can't really say that there's no relationship here. The two have been moving together, I think, more frequently, and really the financialization of Bitcoin, the fact that so much of it now is tied to these ETFs. Well, I think it's more likely it's going to behave like a risk asset and more correlated with the equity markets. And if we look at the last 10 plus years, really, when when the equity markets have been doing well, Bitcoin has been doing well, but multiples of that. When the equity market has been down in years like 2022 and 2018, you've seen Bitcoin really go down far in excess of the broad market. So looking at 2018, down 73%, 2022, Bitcoin down 65%, and last 2 years, obviously, great years for the stock market, and Bitcoin had 2 incredible years. But if we're looking at 2025, year to date so far, everything in the green. So 100% of asset classes have been positive so far this year. Gold leading the way up over 10%. And interesting, as we talked about earlier, international stocks outperforming with a return of 6%. And commodities getting a little resurgence. You got value outperforming. So a little bit of a different, it's very early in the year, but a little bit different story in terms of performance so far in 2025. But everything so far, at least, in the green. Let's end with the U.S. economy and quickly run through some charts here. First, we have the expansion in the U.S. continuing, 57 months and counting. Likely will hit 60 months, so likely will be 5 years when we get the first quarter GDP numbers. If we're looking at the number we just got for fourth quarter GDP, 2.3% annualized, a little bit of a slowdown in terms of growth, but in Q1, Atlanta Fed is expecting 2.9%, so a little bit under 3%. So that would be another quarter of economic growth. If we look at inflation, that's still a story, still an issue until we get core inflation back below 3%. We're talking about 44 consecutive months of core CPI being above that 3% mark. So hopefully this starts to come down this year, and we see a more moderate level of inflation in the U.S. And since 2020, this has been the telling chart. We've seen inflation more than double the 2% Fed target since 2020. So this is why many, and I'm in this camp as well, are arguing the Fed should be very careful in terms of how aggressively they're cutting interest rates until we start to really see signs of lower inflation emerging, because it's not just about the inflation in the last year, it's about the cumulative inflation that we've experienced that's been well above average over the past few years. If we're looking at the budget deficit here coming into the year at $2 trillion, and the big question is, where are we going to end the year? Where's the budget deficit going to be at the end of 2025? And a big driver of that is going to be, well, how much progress can DOGE make, the Department of Government Efficiency? What they've claimed is so far they're already saving $1 billion a day, so that would be $365 billion. There's a DOGE clock now on the national debt clock, which is claiming that DOGE has already saved $83 billion. If that's the case, that's enormous. I think well above expectations. So we'll see where this shakes out. Remember, $1 trillion of the deficit is coming just from the interest expense. And if the U.S. national debt is not going down and interest rates are staying high, well, you're still going to have that trillion there. So really the question is, can DOGE cut $1 trillion overall? That's what they're saying their goal is. Can they get to $3 billion a day? Can they get to $1 trillion reduction in terms of spending? And perhaps they can. Initially, I thought it would be very, very difficult, but it seems like every day they're coming up with new things, and very little pushback, I would say, in terms of what they're finding and saying that they should eliminate. I think most reasonable people are agreeing, saying, yeah, this is something that we didn't know we were spending money on. We probably can cut from there. But are we going to see major cuts? We're going to see that $2 trillion number that some people were talking about. I think for that, it's going to take more than DOGE. You're going to actually need to see congressional action. There's only so much I think DOGE can cut, but I think this is so far well above expectations. It'll be interesting also to see if they are able to reduce this deficit. If it seems like this is going to start trending towards a balanced budget, well, perhaps that's going to have a big impact in terms of interest rates and inflation, and interest rates you could see then potentially start to come sharply lower. If that's the case, if people are saying we're not going to have this big deficit spending anymore, inflation's going to be lower, maybe interest rates are going to come down, and the Fed perhaps then will be more comfortable cutting interest rates. So a lot of this remains to be seen, but so far it seems like we're headed in a good direction in terms of the deficit. And it's only been a month into it so far. So if we're talking about the jobs market, great news there. 49 consecutive months of jobs gains in the US. That's the second longest streak in history. So only this period here, which was the longest expansion in history of 113 months, is longer than what we're seeing today, 49 consecutive months. And we're seeing the unemployment rate actually move back down to 4%, so well below the historical average of 5.7%. So the jobs market still seems to be in a pretty good place. I'd say a much more normal jobs market than we had a few years ago, where supply and demand is more equally balanced. And we'll end, as I like to do, with the most important chart in the markets, in the economy, and that would be comparing hourly wages to inflation. And when this chart is positive, it means good things for the economy, good things for the American worker. And now we've had 20 straight months where this has been positive, and I think we're going to hit 21. So that's a great sign. So keep your eye on this chart throughout the rest of this year. And if it stays positive, again, that means a more improvement in terms of people's standard of living. It means that you have more purchasing power. It means good things in terms of the U.S. economy. So again, this is the chart I go to first and foremost to see what's the health of the economy. Okay, we'll end it right there. Thanks everyone for joining me on the State of the Markets. I'll be back on the next episode with the regular weekend charts, and I'll see you next time. If you're watching this on YouTube, hit that subscribe button for more content just like it.